Well, in this video, I'm going to cover off 8 ways to increase your retirement cash flow. Obviously, an important topic, whether you're already retired or soon to be retired. Increased cash flow means more lifestyle, more travel, more opportunities pursued. It could be more of a contingency to deal with financial needs that might come along the way, surprise expenses in healthcare or other areas. And this topic is for all people transitioning into retirement. I've found over the years that families that have significant wealth are still very keenly interested in how they can make their money go as far as possible. They have wealth because they've attended to those issues throughout their financial journey. And for families with more moderate wealth, obviously it's very important as well, because as they make their money go further, they can deal with contingencies and to maximize the resources they've built up for retirement so they too can experience a wonderful retirement transition and retirement years. So let's take a look at the strategies. Now, strategy number 1 involves looking at the potential of delaying retirement, maybe by 1 or 2 or 3 years, as well as looking at how you're going to handle your government benefits and potentially delaying those as well. It's shocking how little tweaks and changes to your retirement plan can impact your long-term finances and put more money in your pocket. Now, you may not want to delay retirement. You may be very anxious to get moving into your retirement transition. Maybe you don't like your job, or you're just ready to retire. You just want to decompress, and that's fine. But if you have some flexibility and maybe you're okay with maybe transitioning into retirement, I'm going to show you some examples where the ripple effect can be very, very significant. So it doesn't mean you don't retire at the date that you want to, but maybe you tweak it and become a little more nuanced in that transition. And let's look at an example to see how much more money it can put in your pocket if you just tweak your retirement strategy. Now let's take a look at Tom and Sally's situation. We've looked at their situation in past videos, so I won't go through all the assumptions, but the bottom line was they had various expenditure goals and a basic idea that they did not want to build up an estate over time. So if you look at these charts, this is their net worth position. You can see their net worth is going down slowly so that they've used, theoretically, all financial assets by age 90. If you look at their expense allocation, the purple is their basic expenses, and then they have the light blue, which is the travel expenses for the first 15 years of retirement, and then the dark blue represents some vehicle replacement costs in the analysis. Now, they decided to take Canada Pension Plan at age 60, and of course they have their old age security benefits at age 65. When we ran the numbers, in current dollars, the sustainable spend for their basic expenses was $83,000 per year, plus they had $15,000 of travel expenses and the vehicle replacement costs. But $83,000 per year was the baseline income that they could have every single year right through to life expectancy. So we took a look at another scenario where they backed up their CPP benefits and where they backed up the effective retirement date. So let's take a look at that. So we talked about the planning scenario. We ended up making a couple of modifications to their plan. So the first modification was to when they would retire. You know, when I talked to Tom, actually he enjoyed his work. He just wanted to work less and have more flexibility in his schedule. And Sally was exactly the same. So they felt that they probably could find an accommodation with their work so that they wouldn't have to put pressure on their portfolio for 3 years and then allow it to compound until age 63. So we basically looked at a 63 start date, go time for retirement, and we backed up Canada Pension Plan benefits starting from age 60 to age 63. Now, the impact of that change, those two modifications, is they went from $83,000 per year of sustainable after-tax base income to over $100,000 of after-tax income, increase of $17,000 per year after tax. And that's not $17,000, that's $17,000 indexed at 3%. So it was a pretty significant impact, minor modifications with a big ripple effect over the retirement years. And we still were able to keep their vehicle replacements and their travel expenses intact in this particular plan. So if we go back to the cash flow numbers and you look at the budgets, again, they deferred 3 years. Their overall cash flow is higher, as discussed. They still are going through their net worth position out to age 90, but they thought that was kind of a better approach. Now, we made one more modification. We said, well, what if we deferred Canada Pension Plan and old age security benefits to age 70, put more pressure on your portfolio? What impact will that have on the plan? In the last iteration, we did one more minor tweaking to the plan. So we deferred CPP and old age security benefits to age 70. Now, I'd say that both Tom and Sally were of mixed mind around that one. They definitely subscribed to the idea, I think, take the money and run. We don't know how long we have on this planet, so we might as well get the cash flow. At the same time, they were very healthy, longevity ran in their family. So we ran the numbers, and the impact was, when you look at the analysis from Snap Projections, is a further enhancement. So about $5,000 per year of after-tax income increase. So between the initial changes of backing up just 3 years basically, and deferring, putting pressure on the planning assets, and then deferring government benefits, those tweaks between the two of them enhanced cash flow on an after-tax basis by $22,000 per year. And that's not just $22,000 per year in today's dollars. That's $22,000 per year indexed at 3%. Not insignificant. So by just making some minor modifications to the planning and how they're going to approach the retirement, they put, just in this first principle or idea, a lot of after-tax cash flow back in their pockets. Now, for you, when you look at your planning, if you're interested in getting this kind of analysis done, in the show notes, you can get back to our website. We talk about how we offer a complimentary discussion on your retirement income plan, and you can find out through that discussion how you can get your own customized retirement income plan. Okay, let's look at the next principle. Now, the next principle is this principle that I refer to as leveraging tax-advantaged accounts. Now, typically when we say that, we're referring to RSP accounts, RIF accounts, LIRA accounts, and LIF accounts, and tax-free savings accounts for the most part. And so every situation is unique. There is an optimized drawdown strategy between RSP, RIF, and your TFSA and your non-registered accounts for your particular circumstances. This can be driven by your marginal tax rate, if you have a partner, their marginal tax rate, and your expenditure requirements. There's a lot of factors that tie into that. So let's just talk about the RSP RIF conversion. Even if you didn't need extra income, let's assume that you did not have an employer-sponsored pension plan. And when you hit 65, you can qualify for the pension income tax credit. If you have $2,000 of pension income, you'll qualify for the credit. So you'll want to move money from your RSP account to your RIF account so you can get that credit. If you have a partner and they're 65, the same thing applies. Let's say that you really want to leave your TFSA accounts alone, and that would be your last account you'd dip into if you needed extra liquidity in retirement. And there's a good argument for taking that stance. However, in your plan, like Tom and Sally, they have some vehicle upgrades that they're going to do. Those upgrades are going to take a lot of capital. So it may make sense for them to, in that year, draw some of the TFSA out. It's not going to trigger additional taxable income. It's not going to push them into another tax bracket. And then they might judiciously take out some extra from their RSP or RIF accounts over the next few years to pay money back into their TFSA if they didn't have any non-registered accounts. So strategic withdrawals to minimize tax liabilities while at the same time maximizing cash flow is a really important area to take a look at. So let's go back to Tom and Sally. And you can see that in their planning module, we can actually go in and do various withdrawal orders. And so our projection software allows us to go in and model, what about registered TFSA non-registered or registered non-registered TFSA? There's all kinds of modeling scenarios that we can do and apply it to their cash flow generation to see which one is going to be most effective. The other thing we can do is that in years where they have larger expenses when there's a vehicle purchase, we may turn down the tap in terms of withdrawals from the RSPs and turn up the tap in terms of TFSAs. And you can see in the model here, that's exactly what happened. So they were reluctant to take money out of TFSAs, but they did not want to boost their income into another marginal tax rate, so it made sense to go in and tweak it. So tax cash flow modeling is a critical way to enhance the overall cash flow and put more money in your pocket longer term as you anticipate expenses and look after your cash flow needs for retirement. Now, critical to this discussion is just understanding the marginal tax rate that you fall within in your retirement projection. So the value of going through the projections is you can actually see visually where you're landing on the tax bracket. So a good example, this is the Ontario, this is the blended federal and Ontario tax brackets. If I look at 2025, in 2025, the first bracket's up to $52,008, and the overall marginal rate is about 20%. If I look at income between $52,000 and $57,000, it's at 24%. If you look at income between $57,000 and $93,000, it's 29%. So if you look at these marginal rates and then you do a forecast, and let's say you're coming in at 57-ish to 58-ish, there can be a discussion in some of the modeling where you might say, let's take out some more money out of the RSP accounts or RIF accounts and take advantage of the room that we have between the 57 and the 93 at this level of marginal tax. So again, this is just a thought experiment, but when you get down to the granular detail of modeling, you can begin to quantify the ripple effect of leveraging the tax brackets in your planning. This is a critical component to planning. So it's not just about, which account we take it from and what's the sustainable income through retirement. That is the start of the conversation, but then how do we take it one step further and try to leverage the tax code so we pay the least amount of tax possible in our long-term retirement plans? That's another way we can put more money in our pockets. Now, idea number 3 for increasing cash flow through retirement is focus on total return. Now, I've incorporated 2 ideas, and I'm talking specifically about the portfolio for retirement. Let's say you're running a balanced portfolio. So 40% of your portfolio is in cash equivalents or bonds, 60% in stocks. And then the stock piece, you're expecting return through a combination of price appreciation on the stock portfolio over time and dividend distributions. Now, the other piece that I'm focusing in on as part of this focus on total return is keep your investment costs as low as possible. So you focus on total return and keeping investment costs low, you will put a lot of extra money in your pocket through retirement for lifestyle experiences, creating buffer, and reducing anxiety. Okay, so let's focus on dividends and price appreciation. The research is clear. If you're a long-term retirement investor, you are better off focusing on the total aggregate return than just focusing on dividends. And yet there is a strong focus for many investors to focus on dividends. And I get why. It is psychologically much more appealing to receive that dividend, which you view as part of the return, than having the company keep the dividend and reinvesting it. Now, at the end of the day, if you look at the research, the idea of dividends, it's fungible. So whether you receive the dividend or whether the company keeps it and reinvests it, over time, there shouldn't be a difference. And I think you are paying a price, other than the psychological benefit of focusing on just the income side of the equation as a way of dealing with the uncertainty of capital markets. So my bias is focus on dividends and price appreciation, and some sectors of the economy have companies that don't pay a lot of dividends but hold the promise of really good price appreciation. So you're really cutting yourself off at the knees potentially by just focusing on dividend-paying stocks or high dividend-paying stocks. Again, that's my perspective. You might have a different one, but I think the research bears that out. And then the other issue is keep those investment costs low. So the first thing we'll do is we'll take a look at a chart that tries to illustrate why focusing on total return is so important. I put together this chart. So it looks at investment growth and inflation over 20 years from 2004 to 2024. And I'll first of all look at the inflation numbers. So if you had $10,000 back in 2004, you'd need $16,708 just to have the same purchasing power. If you looked at 5-year GICs, their average was 2.59% over this entire period. And that means your GIC grew to $17,100, not a lot more than the inflation rate over that time period. And then if you look at an aggregate bond index over that time period, 10,000 grew to 18,329, a little bit better than the GICs, but not a lot better. And so you can see that the inflation rates in the dotted line along here, and then you've got your fixed term investments that are marginally better than those investments. And I'm not even taking into account taxation on these returns. Look at the S&P 500. That's the green here. Again, there's some volatility in this chart. There's some ups and downs, but over this 20-year period, the S&P 500, that 10,000 grew to 66,155, a 10.75% compounded return. So I'm not saying to you that you need to put all your money in the stock market. I am saying that you should give consideration to a blend, because if you don't, you're missing out on a lot of potential income. Now, is that guaranteed? No, and there's different ways you can build portfolios to be defensive. So again, this is a very basic illustration. Obviously, it's always in the details where you begin to wrestle with risk and return and portfolio construction. But the idea is make sure that you're focused on a blended approach. And when you look at the stock market index, the reason why focusing on dividend distributions is a mistake is that over time, nobody knows which companies and which sectors are going to dominate the market. Whether you own the broad market like the S&P 500 or the all-cap stock index or an ETF, you want to own large portions of the market so that you have exposure to that sector that no one knows is going to take off and generate most of the returns, that you'll have exposure to it. We often hear this idea of diversification, and that's a fallacy. Because if you're too concentrated in your portfolio and you or your money manager end up don't picking the winners, then you're going to miss out on most of the growth in the stock markets. If you look at, the S&P 500, it's only been a few stocks. Let's say, look at the tech stocks, the FANG stocks. 7 stocks drove a lot of the performance of this green line. And yet, before that performance took place, there were other sectors that over-delivered on performance. So it's very important you own the broad market, so when a certain sector takes off, you've got exposure to that sector so you can participate in that growth. Okay, so to put more money in your pocket, you want a blended portfolio so you can have the overall price appreciation experience and focus on total return. Don't just focus on dividend distributions. Now, the next area is cost. Keep your costs low. Now, when it comes to cost savings in your portfolio and reducing those costs, it can get pretty detailed very quickly. And if we're not careful, we can get lost in some rabbit trails and not see the forest for the trees. So for the purposes of this particular discussion, I'm going to try to keep it fairly simple. I know it's a more nuanced conversation than what I'm going to go through with you, but I want to set up an illustration for you so you understand the backdrop. So if you look at Canadian investors, a very large percentage of them are building and managing their retirement portfolios using a combination of mutual funds and exchange-traded funds. And those two products will have at least 2 costs. I know there'll be probably more, but the 2 major costs will be the management costs for the company that manufactures the ETF, or if there's a portfolio manager involved, there's a fee that goes to them. And then there can also be administrative costs attached to it. It could be safe custody costs and securities, legal compliance costs, that kind of thing. Now, there could be a huge range in costs, and I'm not including another cost that can be embedded often with mutual funds, and that would be an advisory service fee, or sometimes referred to as a trail fee. So we're going to keep that discussion separate for now. I'll make a drive-by comment about that at the end of this section. So there's quite a range of costs, like I said. So if you look at many mutual funds, it's very common to see MERs, or management expense ratios, well in excess of 1% per year. And then you can see a lot of ETFs, very low-cost broad index ETFs that could be anywhere from 6, 7, 8 basis points per year to maybe 24, 25 basis points per year. So that's a big difference, particularly when you start using these products to build your portfolio. And if you've got $500,000 or $1 million in your account, we're talking significant cost differences over, let's say, a 20-year period in your portfolio. Now, I'm not saying mutual fund products that have a higher cost are wrong. I'm just saying that you need to be aware of what you're paying for and just ask questions about, why am I paying more for this product when I can get what looks to be somewhat similar for a lot less cost? So I'll give you a good example. There are balanced ETF structures out there with costs, around 24 basis points per year. And it's not uncommon to see balanced mutual funds with costs in excess of 100 basis points per year. So the minute you start focusing on this one area, you begin to see that there could be some pretty significant savings that could go into your pocket rather than the manufacturer's pocket when it comes to your portfolio. So let's take a look at an example. Okay, we have 2 investments, investment 1, investment 2. They're both $500,000. We're looking at a time period from age 60 to age 85. So we've got 25 years of compounding in the portfolio. And you can see we're using 2 different returns, 5.75, 5%. So all things being equal, we're making the assumption that both balanced investment mandates, let's say 40% bonds, 60% stocks, will have similar performance numbers over that 25-year period. I know some of you might argue, but no, the mutual fund that's being actively managed will give better performance. But certainly the data doesn't really bear out that an active manager will do that. So we're going to assume that the same nominal returns will happen for both portfolios. So the nominal return we're assuming is 6% per year. That's what the ETF and the mutual fund are going to return. Now, 6% nominal, we have to take off their management fee. So we took off 100 basis points, or 1% on the mutual fund. So it made 6, but netted 5% after fees. And then the balanced portfolio using ETFs, we assume that it costs 25 basis points or a quarter point per year. And that's certainly out there as an option for investors. So its net return would be 5.75%. So 25 basis points or a quarter point per year cost for the ETF, and 100 basis points or 1% per year for the mutual fund. Now you can see at the end of that time period, the ETF compounded out to $2,095,000 and the mutual fund $1,742,000. So a difference of $553,669. Now, this is just an example to get you thinking about it. I'm not saying that you shouldn't have an actively managed portfolio that's in a higher expense for you. There could be some value that is being garnered. But it is difficult for active managers to do that. So you can certainly find lower cost options that have the potential to put more money in your pocket just because of the cost savings for the portfolio. Okay, so that's another way of putting money in your pocket, the combination of focus on total return and then reducing the costs in your portfolio. One quick comment about this whole costing issue. So I haven't talked about whether there's trailing fees or investment counsel or financial planning fees in this model. So we've stripped that out. That is a different conversation. So I do view investments to a large extent as commodities that we piece together to construct a portfolio that is consistent with your goals and objectives. So that's why the retirement income planning is so important. The retirement forecast basically sets the stage for the right portfolio mix for your circumstances. Once we know the mix, then we can figure out what mix of securities are appropriate for you. And then when we do that, we want to find the lowest cost securities. Once that's in place, your advisor should help you with implementation, monitoring the portfolio, rebalancing, doing tax planning, and updating your retirement plan. Studies confirm there's definitely enhanced economic value that accrues from those activities. So will a mutual fund manager buying the U.S. market or an ETF buying the U.S. market, are they going to add significant value? I think over time the most important thing is to be in the market. Where the value accrues is the plan, and then the implementation of strategies that flow out of the plan. So when you're retaining an advisor and paying a fee for that service, the advisor ideally should not be compensated through any investments that are in your portfolio. It should be a fiduciary arrangement where you're paying your advisor directly for their services, and then when the investments are obtained for the portfolio, like I said, you should be finding low-cost options. And one last comment about focusing on total return, keeping your investment costs low on your portfolio. I'll be remiss if I didn't talk about the taxation on the investment income. So for those of you that have investments in your corporate account or a non-registered portfolio, let's say that in my example, your only source of income was investment income, and you're generating $75,000 of income in the province of Ontario. So if you look at that level of income, that would put you at a marginal rate, if it was just interest income from your portfolio, at 29.65%. If you were generating that income, that taxable income through capital gains, your marginal tax rate would be 14.83%. And if you were generating this $75,000 as eligible dividends from Canadian-controlled corporations, your overall marginal tax rate was 6.39%. So again, it's a fairly self-evident illustration that one of the ways that you keep money in your pocket with your non-registered portfolio or your corporate portfolio is by focusing on how you're generating investment income. So again, I'm not saying that interest income is wrong. It probably should be part of your portfolio, particularly for that part of the portfolio that you need to tap into for income and liquidity. In the short term, you want to be very cautious. But as you extend the duration of your portfolio in terms of when you need assets from it, you definitely want to focus in on price appreciation or eligible dividends in terms of realizing income to supplement your other retirement income sources. So the last section incorporated a couple of different strategies. So now we're looking at strategy number 5. That's downsize your home and declutter. I've got a lot of clients that wish that family had done that way sooner than they did. And in some cases, they never did it. It was left to somebody else to declutter. But this is an obvious area that for some people is something that could really lever up their cash flow. So obviously the combination of these two items can lead to less maintenance costs, less utility costs, lower property taxes potentially, and maybe combining it with a move to a lower cost location. You could see some municipalities where property taxes are lower. There's good service offerings, and some provinces, like the province of BC is probably the best province from a provincial tax standpoint to retire to, and probably Alberta would be the best place to live if you're owning or building a business. But this is a great area to leverage to put more money in your pockets. Another area that you're hearing more and more about is starting a side hustle. And so you might have some natural skills that can be used in small business, so tutoring, consulting. There's also this phenomenon of renting out assets. So you can take your existing assets like a car, an RV, or tools through peer-to-peer platforms. Turo car sharing, Rent My Tool platform, or a Lendit is another platform that allows you to do that. And of course, house and pet sitting networks. So these areas are a little bit like the very first part of my presentation, where it's little things can make a huge difference. This is not appropriate for everyone, but if you're inclined to be open to this idea, it can generate some reasonable cash flow that would take pressure off your portfolio or subsidize some of the costs of traveling and other things that you want to be doing through your retirement years. Now, strategy 7 can be controversial for some people, and that's using home equity. And it could be a combination of reverse mortgage or home equity line of credit. And there are times in retirement where the way that this puts more money in your pocket is if we go through periods of economic calamity, markets don't do very well, your financial assets are under the water or under pressure, by having equity you can lever into, it means that you don't have to sell assets at an inopportune time. And so indirectly, it's going to put more money in your pocket because you can be more tactical about how you're going to generate cash flow until your portfolio recovers. And lines of credit, as an example, are a great way of using a strategy to protect assets that eventually will be very helpful for you from a cash flow planning standpoint. Subscriptions, streaming services, maybe there's some things you can cut down on. My wife and I love gardening, particularly my wife, and we get delicious food, and it can be an economical way of spending time together and doing something you love. Food cooperatives and going from maybe 2 or 3 vehicles to 1 vehicle are all things to consider. Putting more money in your pocket through your retirement years is a stacking proposition. It's all these incremental strategies that when they're added to each other make a really, really big difference. And if you're in a situation where you're trying to figure out how to integrate those strategies, the difference that they'll make in your situation, and you need some implementation assistance, again, go back to the show notes. There's a link back to our website. There we have information about our complimentary gap retirement analysis and how you can get a complimentary call to figure out whether our retirement income planning services might be an appropriate option for you. And if you like this video, check out the playlist that's on your screen. We put together a whole series of videos looking at what amount of capital you need to produce various levels of income. I think you'll find it interesting. You take care. Bye-bye.